Welcome to The Explainer, where we break down the big stories. And this week, wow, the market has this split personality. We've got record highs, total jubilation for some investors, but then you look at the economy and the warning signs are just flashing bright red.
I mean, think about it. The Nasdaq just hit an all-time high. At the same time, you've got these whispers of a recession getting louder and louder. So what's really going on? Are investors just, whistling past the graveyard? Or are they seeing something that maybe the rest of us aren't?
And you really couldn't have scripted a better example of this contradiction. On one side, the economic numbers, especially from the job market, they were genuinely alarming. But at the exact same time, the tech sector was basically throwing a party, pushing the Nasdaq up almost 4%. It's a total head-scratcher, right?
Okay, so let's try and make sense of this. First up, let's dig into those economic warning signs. This is the stuff that has a lot of analysts really worried.
So it really all kicked off with the jobs report on Friday, and it was a real shocker. The economy only added 74,000 new jobs. I mean, that's way below the 102,000 that economists were expecting. But honestly, that's not even the worst part of it. The real damage, you see, was hiding in the revisions to the numbers from the last couple of months. So, for example, take May. They went back and slashed the number of jobs by 125,000. Just gone. One revision, and a gain we thought we had was completely wiped out. And then you look at June, boom, another 133,000 jobs just disappeared from the data. So when you put those two together, all that job growth we thought we had in May and June, turns out it just didn't happen. This paints a picture of a labor market that's been sputtering for a while now.
You can see why Dave Sekra, he's the chief U.S. market strategist over at Morningstar, said, you don't just take these numbers with a grain of salt. You need a boulder of salt. And that really gets at this feeling of skepticism. How healthy is the labor market really?
So what do you call it when you have this toxic brew of a weak job market combined with prices that just keep going up? Well, it's brought back a word that nobody wants to hear, a real throwback to the 1970s, stagflation. And it's not just talk. An economist at Fitch Ratings said that because of this data, the risk of stagflation has, and I quote, risen meaningfully.
Okay, so that's the gloomy side of the story. Now for the big paradox. How on earth did the market look at all that bad news and use it as fuel for a huge rally, especially in the tech world?
All right, here's the key. It's kind of wild. Investors looked at that awful jobs report and made one gigantic bet. The bet was that the Federal Reserve would basically have its hand forced, that they'd have no choice but to cut interest rates. And you can see it right here. The odds of a rate cut in September just skyrocketed. It went from less than 40% all the way to 87%, almost overnight. And that, my friends, is the market's classic bad news is good news logic. See, for those big, high-growth tech companies, the ones that borrow a ton of money to expand, the idea of cheaper money is like rocket fuel. So investors just piled in, and boom, the Nasdaq shot up to a brand new record.
But it wasn't just about hoping for a Fed rate cut. The rally was also built on some seriously strong earnings. We're talking about Microsoft growing its revenue by a massive 18%, and Alphabet. Their search business wasn't just growing, it was actually speeding up. So this wasn't all just speculation. It was backed by real performance. And then you have Apple. What a move. They come out and announce a $100 billion investment in U.S. manufacturing. And what did that do? Well, it got them an exemption from new chip tariffs. The market absolutely loved it. The stock surged 13% in just 3 days. Wow. All right, so let's zoom in from the big picture for a second. Let's look at a couple of individual stocks that were making headlines this week, because they really show how these big trends play out on the ground.
And this slide tells the story perfectly. You've got two completely different outcomes. On one side, a company like Gilead Sciences, they had strong drug sales and the stock shot up over 8%. Simple as that. But then, look at The Trade Desk, an ad tech company. It got absolutely hammered, dropping almost 40%. Why? Because it warned that all this talk about tariffs was making its clients nervous about spending money on ads. A perfect picture of those jitters versus the jubilation.
So that's where we stand, and it really sets the stage for the week ahead. With a market this conflicted, here's what investors are going to be glued to.
Next week is really all about one thing: inflation. On Tuesday, we get the Consumer Price Index, the CPI, which is what you and I pay for stuff. Then on Thursday, it's the Producer Price Index, or PPI, which is what it costs businesses to make things. These two numbers, they're going to be absolutely crucial for figuring out what the Fed might do next.
And of course, earnings season isn't over. We're going to see if that tech momentum can keep going. We've got reports coming from Palantir and AMD. Plus, we'll get a really important look at how the consumer is holding up from a giant like McDonald's. Are people still out there spending?
And all of this leaves us with the big billion-dollar question that's probably going to define the market for the rest of this year. Is all this optimism, especially in tech, a sign of real strength? Is the market correctly seeing a soft landing ahead? Or is it just a dangerous bubble, flying too close to the sun on the promise of cheap money while ignoring all the economic warning signs? I guess the next few weeks are going to be very, very telling.